Today I'm going to talk about the decline in job vacancies marks a shift in US labor market dynamics. As you know, jobs data has been a very crucial data all this while for the US. And if today's what I'm going to discuss today the data is going to gel with the non-farm payroll. It gives us more credence to whatever we're going to discuss today. So first of all, right, in October, US jobs opening declined to their lowest in over 2 years, reflecting reduced demand for workers due to increased interest rates. Now, this is something we expect to happen already sooner or later, even though we have been getting surprising data, especially from the non-farm side, right? So, but in the long term, like I've always discussed, when you have high interest rates, sooner or later it's going to affect the market. And probably, this after today, we would may have a clearer idea on how bad the situation will be in the future if it's not already happening, and we'll see. Okay. So the numbers of open unfilled position dropped by 617,000 to 8.733 million, a figure not seen since March 2021. So this is really crazy. Additionally, the ratio of job vacancies to unemployed individuals fell to 1.34, the lowest since August 2021, suggesting a shift in the labor market with fewer resignations potentially easing wage inflation. Now, one way to understand whether the market is really good or no good is just looking at the resignations, because one of the fastest way to which we believe people can see to get a higher pay is when they resign, and then because they have a new job potential offers and stuff like that. That's how people increase the pay at a faster scale. Now, when people will always only resign if they don't have confidence that they can jump to the next job easily with a higher pay. And especially when the economy is bad, right? You even have fewer resignations. So we are seeing that there is fewer resignations happening already. So there is a transition already in the market. That's why I call today's title labor market dynamics, a shift in labor market dynamics, right? So the surprising reduction in job openings coupled with signs of slowing inflation suggests interest rates may have reached their peak. Okay, something we discussed during Wednesday's report, right? I brought this up in detail already about the potential of interest rates hitting a peak. Now, the report also showed a decrease in job openings across various sectors and regions, accompanied by a slight drop in hiring to 5.886 million and a modest rise in layoffs. Okay, there is just a modest rise over here in layoff, but a slight drop in hiring that's already happening. Now, these trends indicate a potential easing of wage growth and price pressures, though the labor market remains relatively stable. Okay, it's still considered stable over here, what we are seeing, okay, without the need of significant adjustments by the Fed. When I talk about adjustments here, means that the Fed don't need to and when you talk about adjustments, you can also refer to rate cutting exercises. Now, they have been calling for the Fed, the even articles saying that next year, 2024, you will see Fed cutting 4 times. Now, for that to really happen, we need to see some catastrophe in the market, something really bad in the market, then 4 times. But if everything is like what it is right now, I don't think it would be that easy, because the Fed still needs to ensure that inflation drops to 2%, something that they have talked about, because even though there are calls to increase the inflation expectations, to 3% instead of 2%, but the Fed has so far been reluctant to oblige to that way of thinking at the current moment. Yeah. So this stabilization in the labor market and peaking interest rates could lead to a less hawkish stance from the Fed. And we have already seen that, in the coming FOMC meeting, and no one the potential of the Fed hiking its rate is not there. So the thoughts are right now that the interest rates has peaked for the time being already. So also we have talked about this on Wednesday. So if the market anticipates a pivot in monetary policy, it could lead to a softening of the US dollar. Okay, pivot here means that now they are going to maintain the rates and then looking into cutting the rates already. So there's a change in the policy. So when we are already at maintaining rates already, so the next pivot would be looking into really cutting rates, because right now the Fed hasn't announced that they have said this is their peak at the current moment. So if there's an announcement, that will be the first pivot, and then what the next anticipation would be to cut rates, right? So when the market gets a whiff of this, definitely it's going to lead to the weakening. Softening here refers to weakening of the US dollar, because high interest rates have been a key driver of its strength. Okay, so something that we need to understand and look for in this change. So however, the overall direction will be influenced by a combination of domestic economic indicators that's coming out from time to time. The very first one, you're going to get it from today, is the non-farm payroll data, and global financial conditions, of course, is going to add into this. What we're having is the potential, the escalation of the Israel-Gaza war that's happening right now. Like I've also discussed in previous reports already, as long as it's contained, then no issue. But if it's not contained, it's going to involve more countries, then that is a different case. So when that happens, right, the US dollars tend to gain strength because it's not also as a safe haven currency. So there are many aspects over here. Doesn't necessarily mean that the moment the US say they're going to cut rates, the dollar can soften. That is one scenario, but we also need to look at the global financial conditions also at the same time. Okay, so with that, that's a report for today. Let's move on to the charts right now.